All right, let's demystify one of the biggest forces in all of finance, credit risk. Now, it might sound super complicated, but I promise, it's a concept you already get. And by the end of this, you'll see the exact framework banks use to manage literally billions of dollars of it every single day. So let's start with this. I mean, we've all been there, right? You lend a friend 20 bucks, and then you get that little knot in your stomach, that little flicker of doubt. Well, guess what? That is credit risk. It's that simple, powerful fear that you might not get your money back. Okay, now let's scale that feeling up, way, way up. Because in the world of global finance, we're not talking about $20. We're talking billions. And when that much money is on the line, just having a gut feeling is not going to cut it. Nope. You need a rock-solid framework to pick apart that risk from every single angle.
So here's our game plan. First, we're going to see how credit risk is way more than just simple loans. Then, we'll sort all that risk into 5 distinct buckets. After that, we'll figure out how to measure just how risky each one is. And finally, we're going to connect it all to the one thing that matters most, the price.
You know, when most of us hear credit risk, our mind immediately jumps to something like a mortgage or a car loan. But honestly, that is just the tip of the iceberg. The real story is so much more interesting, because this risk, it's hiding in all sorts of places you'd never expect.
So to get a handle on all these different forms of risk, analysts have a system. It's pretty smart, actually. They sort every single potential risk into one of 5 main categories, or as they call them, buckets. Let's dive into each one.
First up is the one we all know and, well, the one we all know, loan risk. It's the classic. A company takes out a loan, it's right there on their balance sheet, and the risk is crystal clear. They might not make their payments. This is really the foundation of all credit risk analysis.
Okay, next up is contingent risk, and this is where things start to get really interesting. With this one, get this, no money has even changed hands yet. This is all about a legally binding promise to lend money down the road, like a corporate line of credit. The bank can't just back out. So even though the loan isn't real yet, the risk is very, very real.
Think about it like this. A parent promises to co-sign a car loan for their kid, but only if the kid gets a job. Right now, the parent isn't on the hook for a dime. But the second their child lands that job and walks into the dealership, boom, that promise becomes a real, live financial exposure. That, right there, is contingent risk.
Our third bucket is settlement risk. And this one is wild. It's a super high-stakes risk that might only last for a few hours or even minutes. Imagine a bank does a massive currency trade. They wire millions of euros to another bank, and for that short period of time, they're just waiting for millions of US dollars to show up. In that tiny window, a total disaster could happen.
You know that feeling? It's exactly like that anxious moment after you've mailed a package for an online swap. You've done your part. Now, all you can do is wait and hope the other person comes through. That brief moment of total vulnerability, that's settlement risk in a nutshell.
All right, bucket number 4, pre-settlement risk. This is all about long-term deals. Think a 5-year derivative contract. So what's the danger? Well, what if your counterparty, the other person in the deal, goes bankrupt in year 2? Now, you've not only lost the deal, but you have to go out and replace it on the open market, probably at a way worse price. That's why people often call it replacement cost risk.
And that brings us to our last bucket, issuer risk. Now, this one's a little different. You haven't loaned money directly. Instead, you've bought something like a corporate bond. Here, the risk is that the company that issued the bond starts to look, well, a little shaky. Even if they never actually miss a payment, just the perception that they're riskier can make the value of your bond totally crater. You can lose a ton of money without a single default ever happening.
So there you have it, the 5 fundamental buckets of credit exposure. You've got your straightforward loan, your promise of a future loan, that scary in-between moment, the long-term deal risk, and the risk of an investment's value dropping. Figuring out which bucket a risk falls into is always the critical first step.
Okay, so we've sorted our risk into the right buckets. Awesome. But that's only half the story. Now we have to figure out how much risk we're talking about. And to do that, analysts basically have 4 dials they can turn to measure just how severe it is.
The first dial is term, and this one's pretty intuitive, right? The longer the time frame, the more time there is for things to go completely sideways. An overnight loan is way, way less risky than a 25-year loan for a new factory, simply because there's less time for chaos and uncertainty to creep in.
Next up, collateral. Is the loan backed by something real? A secured loan is always safer.
But listen, not all collateral is created equal. Having a claim on cold, hard cash is rock solid. But a claim on some weird, specialized factory equipment that's hard to sell? Much less so. And an unsecured loan with no collateral at all? Well, that's the riskiest of the bunch.
Our third dial is commitment. This one's all about a simple question. Can the lender back out? An uncommitted line of credit means they can basically cancel it whenever they want, which is super low risk for them. But a committed facility, that's a legal contract. The lender has to provide the money, no matter how bad things get for the borrower. That cranks their risk way, way up.
And the final dial is seniority. This one is huge. It basically determines your place in line if a company goes bankrupt. The best way to think about it is like a waterfall of money. Senior lenders are at the very top of that waterfall. They get paid first from whatever's left. Subordinated lenders, they're at the very bottom, right before the stockholders, which means, yeah, they often get nothing at all.
So here's the key. You combine these 4 factors to see exactly where a deal lands on the risk spectrum. The absolute safest thing you can imagine is an intraday senior loan that's secured by cash. And the most dangerous, a long-term, subordinated, unsecured, and fully committed loan. It's a whole different universe of risk.
And that brings us to the final, and honestly, the most important part. We've put the risk in its bucket, we've measured how bad it is, but why? Why does any of this analysis matter? Well, it all comes down to one simple, powerful thing: price. This is the one fundamental rule of finance, and it is beautifully simple. Risk demands reward. The more danger you're willing to take on, the more you have to be paid for it. That extra payment, that compensation for taking the chance, that's the price of the risk, and we see it as an interest rate or what's called a credit spread.
And this chart just lays it all out perfectly. For that safe, short-term, senior, secured loan, a lender is only going to charge a tiny little premium, a small credit spread. But for that super high-risk loan, the one that's long-term, unsecured, and subordinated, oh, you better believe they're going to demand a much, much higher price to make taking on that level of danger worth it. Every single dial we talked about gets baked into that final price.
So there it is, the framework for thinking about credit risk. First, you identify which of the 5 buckets you're in. Then, you use those 4 dials, term, collateral, commitment, and seniority, to measure how intense it is. That's it. That is how the financial world prices risk every single day. So, the question I'll leave you with is this. Now that you've got the framework, where do you think the next big hidden risk is lurking in our economy? Something to think about. Thanks for tuning in.